Hi, everyone. My name is Matt Brown. Welcome to the Direct Private Investment Show. With me in the studio is Bruce Roberts. Bruce, welcome.
Matt, good.
And thank you. And with me on the line from the bright lights of, where are you, by the way?
San Antonio, Texas.
You see the bright lights of San Antonio, Texas. Garrick, welcome to the show. So, understanding security structures. This is a big conversation and an important conversation for you as an investor. Bruce, I'd love to start with you. Kick us off. What's the key thing to land for investors when it comes to types of security structures?
If you look at the broader picture of making direct private investments, there's a bit of a puzzle here where all the pieces need to fit. You start with what are you trying to accomplish in your portfolio as you start to include direct investments in the portfolio. Well, then it sort of follows that what you're buying needs to be structured in a way to meet the goals that you have. The simple way to look at that would be, am I looking for current income, or am I really more looking for capital gains? In the world, a lot of direct private investment tends to be of a venture stage business. So those would need by their nature to be extraordinarily high capital gains to make up for the risk you're taking on. On the debt side of the equation, you still should get a higher return relative to the public markets because just by their nature, they're more fragile companies. There's illiquidity or to buy and hold security, et cetera. But the structure of either one of those needs to be correct. And this is where, this is why you have specialist funds, frankly, is because they typically are either debt buyers, they're private credit, they're private lenders, or they're equity buyers and they're venture capitalists. Because we're financing a client that has a capital need, we have to be fluent in both sides. And the investors that participate, we're looking to offer them an investment that meets their criteria, but the structures have got to be right. So they're very different. We can spend some time here if you'd like, talking about what do you need to look for in one type of investment versus another.
Well, let's do that now then. Okay. You get debt and equity. How do these play out in the world of our investor community?
Sure, we start on the equity side of the equation first. Equity by its nature is a higher risk security because everything sort of is pinned by if you had to sell the business and now you've got cash you've got cash for that business. Well, where does that cash go? Who gets first call on that cash? Equity is going to be behind debt. Debt is a senior security, a senior instrument. But even within the equity category, for a venture stage business, and let's define venture as, does not have operating cash flow, and you're investing privately, you should be investing in a form of preferred stock. Preferred stock, as the name would imply, is senior in liquidation to common stock, right? Your founders of a company, they receive common stock. Employees in a company that might have options in that company, there are options to buy common stock. But those who are putting cash in are going to get preferred stock. In accounting, we talk about LIFO, last in, first out. Well, you can take kind of a LIFO approach to investing is whoever's showing up with the money, and the other little rule here would be the golden rule. Only in this case, it's the gold rules. So that last money in, should have a liquidation preference over others. Now, certainly as the company, builds in its value, there will be a transition point, certainly when it goes public, where it's issuing common stock. But, as a financial investor at a private company, you should be in a preferred position. Now, within the preferred position, there's different flavors of preferred. The typical flavor that you would find in venture is what's called convertible preferred. So it's an either or. When a company has a liquidity event, you look at what is bringing more value to you as the investor. Do I realize on the preferences, and often there's an accruing dividend with this company, or is the value at that exit so great that I'd rather convert to common and take a pro rata share of the proceeds that way? Okay, you get to different flavors of preferred stock. Probably the most aggressive is participating preferred, and that's a cake and eat it structure. You get the preference, and then you convert to common and you participate pro rata with common. So these are some of the nuances on the equity side. They're really not nuances. They're pretty fundamental to the structure. And I would say this, if it's not right on the front end, when you write the check and you put your money in, it's not going to be there on the back end.
Right. I like to have my cake and eat it too. So I'm very
You want to participate
I want
for,
participating.
well, for an earlier stage company, that can be more appropriate. As the company matures and has more to show for itself, then you quite naturally kind of flow into convertible preferred. And it really, that's kind of the dynamic of structuring the deal is, you want to be in the most preferred position. You want to have the most attractive security from a return standpoint. But, again, depending on the nature of the business, its status, and the relative upside of it, you may be in convertible preferred, and frankly should be pretty happy about it because that's a nice structure to be in.
Fantastic. So, Garrick, over to you. You do speak to investors every single day, and very curious for you to help our audience understand when you engage with an investor, to Bruce's points around debt versus equity and different types of debt versus equity. How do you help an investor understand what is the type of security structure that is most appropriate for them?
Yeah, very good question. And it's a very relevant and very important question in this world because by and large, private placements in general, and for existing investors in this world, they know this very well. And for new investors, this is something to learn. But private placements in general are considered illiquid in nature. There's no traditional secondary market or exchange to go to get in and out of any particular security. Not to say that it can't happen, but let's just use generalities just for safety's sake for now, right? And so a lot of the conversations that I'll have with existing investors or new investors will typically flow around their expectations and their needs for liquidity coming up on the horizon, right? And so if you separate the two types of basic asset classes out in the private placement world, debt and equity, traditionally speaking, once again, debt is considered a shorter term type of investment that is accompanied by an amortization schedule of some sort, where part of what you're receiving back is principal and part of what you're receiving back is interest. It's usually taken place or given to the investors on a monthly basis. And with that, with every dollar that's given back to you throughout that time on the debt side, each of those dollars paid back into your pocket are doing two things. It's reducing, one, your exposure to that particular industry, right? Whether it be agriculture or aviation or whatever it could be. And two, it's in essence reducing your risk over time because more of that money is coming back into your pocket. So throughout that time, and level of exposure to an industry will change based on the length of that note or maturity, right? And so the other thing to think about here in terms of debt securities versus equity, and specifically sticking with debt still, debt, as Bruce had mentioned, is going to be typically located at the highest point of the capital stack, or as Bruce called it, the liquidation preferences for within that company, right? And because it's located higher on the capital stack, there are, and in addition to that, there are various levels of collateral that are accompanied by that, or promises such as personal guarantees, corporate guarantees. Collateral can be a UCC on the business, inventory, accounts receivables. It's a wide range of things that can get very creative, but all of which are designed to help pad the investor and protect the investor, and to help them get their money back one way or another, right? Whether they're going to take over the business or they will be paid back in from a traditional route of a normal maturing amortization, right? And so because of that, it's something to say that anyone, you would expect the premise of risk and return to play a large factor here, right? And typically a fixed income investment or a bond investment on the public markets, those will traditionally yield less than equity returns, and the same holds true within the private markets as well. But the caveat here is that because these are private placements, we can typically or many times, many of the investments we will bring to to investors here at Carofin will typically show investors returns that are in excess of typical bond market sort of yields, and they're butting closer towards an equity type of return, while taking an equity, taking a debt type of risk, because you have all of that collateral listed with an equity type return tied to it. And so it's a special, sort of world. It is a more traditionally considered a more conservative investment. And then, of course, taking that on the opposite side to it, right? You would think of equity as the longer tail investment, as Bruce had mentioned, and puts investors in a position where they can capitalize on a much larger multiple, potentially speaking. Of course, there's no guarantees or promises, but ultimately it creates a good balance if investors could get into a few versions of these types of basic asset classes that are within any sort of private placement world, right? And because diversification is key here.
You can look at a structure for debt. There's sort of three elements to it. And I'll speak to each. The first would be, what's the maturity? The second would be, what's the interest rate or the rate of return on it? And the third would be, what's the source of repayment? Let's take them in those orders. Maturity, I would broaden to include, well, it's how are you paid back the principal, right? And by and large falls in one of two buckets. It's either amortizing, which means you have a continual reduction in the principal because a portion of the payment you're receiving, let's say it's every month, could be every quarter, but we prefer every month just to be that much closer to whether the deal's working or not. And what you've essentially done is you've reduced your exposure on two fronts. You're getting cash back, that one is a rate of return and one's a return of principal. But if you look at it in the aggregate in terms of its cash off the table, you're reducing that consistently over the life of the deal. A shorter term instrument that fully amortizes is obviously going to have bigger component of principal in the front end, much like your mortgage on your house. If you have a 15-year mortgage, it's going to basically amortize quicker than a 30-year mortgage, right? The front 30-year mortgage, it's all interest. 15 years, it starts to look meaningful sooner. So that's maturity. What's the maturity of this instrument? And while we very strongly would suggest these types of investments should not be a source of necessary personal liquidity for the investors in the future. I mean, these are high-risk securities. You could lose it all, and you need to go in with that attitude. You still would have a horizon of when you would like to see the money come back, right? The second one is interest rate. The interest rates go up and down in the market, and what that basically does for the investors, it says, okay, what's my risk-free rate, if you will? In other words, the U.S. Treasury market, as we're speaking today, has gone up dramatically, roughly, on the order of 3.5 to 4 percentage points, in the last, say 6 to 9 months. And so what that says to you, if it's a U.S. Treasury, by and large, the risk-free rates for, say, a 10-year investment, or let's go shorter maturity since that's appropriate. Say a 3-year investment might be in the order of 3%, right? Am I happy with 3%? Well, if inflation's higher, maybe not, right? But nevertheless, that's the hurdle. It doesn't necessarily follow that the rates in the private market go up by 3%. There's a nominal amount that you need to get of a return. So even in a zero interest rate environment, we've by and large been in a 12 to 15% rate of return for our private transactions. And in some cases, we can put a profit share on it as well. We can add equity warrants to create some other back-end protection. But, the flip side of that equation is it doesn't follow that what was going to be a 15% rate of return investment from one particular issuer now needs to be a 17% rate of return, because at some point the company just can't service the debt. So you have to be kind of realistic about what can this company pay me back. There's a saying we have in the South, pigs get fat and hogs get slaughtered. So I think that has a pretty good relevance here. The last one is source of repayment, and the first one would be, well, it's an obligation of the company to pay it back. So based on their operating cash flow, they should be able to pay it back. Depending on the nature of the ownership of the company, if it's a wholly owned company, it is quite appropriate to ask for a personal guarantee. But here I would caution you, if you're thinking the personal guarantee is going to be somehow this person has the personal liquidity to pay back your note, well, they probably wouldn't be borrowing your money at 12 or 15% if they had the liquidity to pay you back. probably would go to a bank, and borrow it at less than half that cost, right? Now, the personal guarantee is kind of a hearts and minds kind of commitment. Legally, they're obliged personally to pay back that note. And that they should be doing everything they can do to pay you back, right? As opposed to walking away from it, right? Bankrupting the company and moving on to their next adventure. No. If they got a personal guarantee, they're attached to your note and you want that. In some cases, the ownership is so distributed, it's not reasonable to ask for it. If I own 10% of a business, why would I guarantee 100% of its debt, right? So there's that whole question. But then you get into other types of collateral as a source of repayment. And unfortunately, when we have a deal that's been challenged, we've had to go to realize on that. So for example, years ago, we did a working capital financing for a very large corn grower, farmer. We made sure that our corn was separately stored in a separate silo. We physically went there, looked in the silo to make sure the corn was there. And when the company actually began to fall apart, they started missing their payments. We contracted with, in this case, it was Cargill. The truck started rolling. Our corn rolled up. They did their test. We got paid 48 hours later. It was a pretty beautiful system, actually, that they had. Didn't want to foreclose, but in fact, we did. In that case, we'd actually also entered into hedging so that if the price of corn were to drop, we essentially had put options that we knew we could sell that collateral at a price that would protect our investment. So it worked, okay? And we've certainly had other circumstances where, regrettably, we've had to, foreclose, had to liquidate assets, and, that's the source of repayment we had for the note. So again, 3 things to look for in your structure. What's the maturity? But in this case, maturity really is, how am I getting paid back principal over what period of time? And then, is it gradual or is it at the end? Again, if it's at the end, there's a liquidity risk inherent to that. Chances are they're going to need another source of liquidity to pay off your note. So begs the question, do you like that risk? The rate of return, how's this rate of return look relative to other more liquid instruments? And then lastly, how many sources of repayment? And these are, frankly, the same underwriting criteria that a commercial bank, any lender would look at.
This is very, very helpful, certainly for me as an investor, but I'm sure for our audience as well. Garrick, I'm going to bring you back into the conversation here for a moment. We've touched on debt versus equity. Now, as an investor, to Bruce's point, it's like, well, how am I going to get paid back? So could you touch on the different payback periods typically involved in a equity investment versus, say, a debt-based deal?
We'll start off with equity, I guess, because you mentioned that one first. So in terms of payback periods, an investor should think of equity as Bruce and I have both mentioned here, as a longer tail investment. The earlier the stage of the company, right? So the closer they are to a pre-revenue or is starting out, Series A, sort of venture type of investments. Typically speaking, the longer the tail will be for that investment because they have to get up and running. They have to ramp up their, product and solutions of what they're going to go out and market and sell. They have to sort of blaze a trail in, new areas of creating contacts and growing a sales channel. And all of those things take time. Yes, there are unicorns out there, and we've all read about them, and we all have friends that have found a way to find one of them. Right. But by and large, for every one of those unicorns, the Facebooks, Pelotons, whatever it could be, that have that sort of meteoric rise, at the same time, there's probably 1,000 companies you've never heard of, with that, that's what we typically will tell investors is, first of all, obviously, yes, think of this as an investment that you would be okay if everything went bad. And likewise, if it goes well, sharing with investors a potential range of what that could look like, based on company progress. And, something we're, particularly proud of here is once we do get up and running with those particular investments. And I think it's a huge differentiator for us, just based on my 15 years of experience in this industry, is the fact that Carofin has this rock solid commitment towards tracking these investments once they have launched. And it puts us in a great position to give investors information shared from both the quantitative and qualitative side of things within those companies. So a progress of the investment, monetarily speaking. And then, of course, likewise, to also share with them company updates on a regular basis based on where the company's been, what they're doing today, and their expectations or what they could expect for the company to be doing in the future based on what they have presented to us. And what that does is it allows the investor to have a very strong grip on the pulse of any given company at any given time. So yes, that's on the equity side, obviously, right? And then, of course, on the debt side, taking a look at this in terms of most of the investments. Let's use Carofin as the example, right? Most of the investments Carofin will normally come to market with will typically be shorter in nature in terms of maturity on the debt side, anywhere from 12 months to 42, right? 45, right? They will typically fall within a 36 months should be a nice strong average, 24 to 36 months, somewhere in that range. And with that, we will typically try to add various collateral sort of measures to this, covenants, safety nets in place for those investors' dollars, and that can come in the form of interest rate reserves, right, corporate guarantees, whatever it could be. There's a whole list of them, and we will typically try to set out an amortization that is not predatory towards that company, because the last thing you want to do as a creditor is chop the left hand off of a guy who's supposed to make you a chair with both of his hands and then tell him to make me that chair faster. Well, chances are he needs both hands to do it, to make a quality product. And I'm not saying that that's what happens. I'm just, giving you an example of how it is a delicate dance. And it's one that, having to balance the investor expectations and maintaining the strength of the company, over time is something that we become very good at, in terms of, being able to create successful redemptions for our investors. But yes, by and large, the debt investments are going to be considered shorter term in nature. The overall return profiles will typically sit in that 11 to 14, 15% range, somewhere in there. So if you're looking for a 24x multiple, we need to be looking at the other side of the aisle for that. So yeah.
Equity is very different. It is you should, on any earlier stage venture deal, you should figure on 10 years. But the challenge is time is not your friend. Why are you investing in this category? Well, you're investing in this category to create a rate of return that's compelling. Well, a 5 times return on your money sounds great if you're getting it in 3 years, right? Because that's north of 100% return per year. 5 times the rate of return over 20 years doesn't sound so great, right? Right? That's a 4% return, I guess. So, time matters, right? So when you're going into a deal, one of the questions is, well, what's this company worth? What kind of value should it be set? Because they're interrelated, right? If what you're really doing here is you're trying to generate a rate of return, your starting point is whatever price you're coming in at. We typically call it pre-money valuation. But at the end of the day, what's really going to drive the return is what share price did you pay for it? The pre-money valuation divided by all the outstanding shares at the time generates a price, right? So what I typically do on these is I say, okay, let's see what the company's projections look like 5 years from now. Pretty impossible to create a 10-year projection, honestly. But what's the implied value that the company has created over 5 years? Okay, now let's cut that in half, because they're not going to hit it. I mean, I don't care what they say. At least you shouldn't assume they are. Okay, they're optimists. They wouldn't be doing it if this were optimists. Their glasses are all half full. You need to be a little half empty going into this. Now, you can run the math. This is basically, rate of return math, present value math. You got a future value of, X plus something. You're going in at X. What does that implied rate of return turn out to be? What's the math suggest? If it's an early stage equity investment and you're less than 35% projected return going in, you're probably coming at too high a price. Now, by the way, that exit multiple, it's going to be what do they get in sales and what the comparables tell you in the marketplace for where those would value. If they're really a business that's intent upon generating cash flow, any number of things can drive that exit multiple. And by the way, you should look at probably a private sale exit multiple, not an IPO potential. Okay. Because, sometimes there are IPO markets, sometimes there aren't. It's fluid, right? But what you probably can count on, if you're generating a valuable business, some other large business is going to want to buy it, because for them, it's a buy versus build decision. And that's why the M&A market is so vibrant. But, getting back to this whole period, time is not your friend. If you want to make sure you need to come in at the right price. And one way I think probably the best way to do it is, get some reasonable estimate of what an exit value would be, work your way back to what they're asking for the entry point. And then does that generate a rate of return? It's a basic sanity check. Is the rate of return coming in here sufficient? If it's 10%, it ain't going to work, right? Why would you sign up for that? It could be the neatest company going. You can really love what they do, but you're settling for a rate of return that, for the risk you're taking, just isn't sufficient.
Well, gentlemen, it sounds very, very exciting, but in terms of the opportunities that you guys have described, but also the risks are very real. And what I'm taking away from this episode of the Direct Private Investment Show is work with an expert.